Hey guys, I hope you're doing great. It's Joe Gardner here. Today I'm going to be shedding some light on a key area of the home loan process, and it is the types of things that a bank or a lender is going to be looking at when they make their decision on whether to approve you or not. Now, as a broker, we've got access to all the tools that the banks use to do their underwriting calculations on. And that could be online web tools, which we have special broker access to, or spreadsheets that their credit assessment departments use directly. So we know the numbers inside out, and we're able to tell a client down to the nearest $10 exactly what the bank would lend to them. So that's a fantastic part of our service. So we deal with this day in, day out. And I'm going to be going into the 7 key areas that banks really look at as the most common things when we do the underwriting assessment process. So we take care of this as a first step so that we know when we go to a bank they're going to green light it. That's what they want us to do, and as you as a customer, that gives you more confidence in going forward with that bank. So first up, they like to know your deposit. They'll take into account the size of the home that you're looking to buy as well, and by size I just mean the size in terms of value. So your deposit and your house's value are going to be taken into account there. So banks are obviously more comfortable in lending at 80% loan to value ratio or less, but they will lend higher in certain circumstances to 90 to 95% as well. And what they're really going to look at here is just a savings history. So can this person actually save money? Are they generating enough income in their lives to take care of all the needs that they have, plus have some over left at the end of the day to save? That's a key indicator for them that you're a good risk. So they're going to be looking for what they call genuine savings. And genuine savings is essentially money or funds that have been sitting in your bank account for 3 to 6 months or more. And that's a good indicator for them that you've got a cushion of cash at the ready to either put into this property or to put into a loan in any emergency situation. So that's the way they look at your deposit. Secondly, you can't get a loan without income. You need to be able to service the debt. And servicing is just a fancy word for making repayments. Now, banks aren't in the business of giving out money if they're not going to get a return on it. So they want their money that they've lent you back to them with interest. So they're going to definitely hone in on you having a good income, whether that's from a business, you need to show your business income, or if you're in a salaried profession, then you'll be showing evidence for your pay via your main bank transaction account history, or your pay slips from your employer. They're another way that we evidence that. So that goes into the calculations. Again, a different type of income here, but it's rental income. So with many clients and people in Australia being property owners for investment property purposes, they have a source of income coming in from the property, and that's rental income, and the banks will take that into account. So it makes it much easier to get a residential investment loan because you can use that as a proof of evidence. And let's say that you're looking at buying in a particular area, or you're assessing some particular property. We can put in a guesstimated amount for a property in that area. So let's say you're looking at Yarraville or Randwick. We can really quickly assess via your calculations and also via the databases and tools that we have access to what an average rent for, say, a 2-bedroom unit in Randwick would be, and we can use that rent as part of the rental income calculation. Now, the banks are going to be conservative, and they'll do a thing that they call shading, and this just means that they're going to take only 80% of that income. So if you're getting $100 a month, they would say, oh well, we're going to bring that back to assume only $80 a month, because they want to have a conservatism built into their assessments. So they'll shade that income. That's a pretty blanket rule across the board, where not all lenders would take 100% of the income. And that's good for you. It lets you know that there's a bit of a buffer that the banks are building in. So they're taking care of your interests as well by not lending you money irresponsibly. Fourthly, if you've got bonus or overtime income, that will be taken into account, but it may also be shaded. With regards to bonuses and overtime, it does vary lender to lender. So if you're really getting down to the wire, that might be a key decision driver in which lender to go for. But for many of us, a bonus is just that. It's cream on the top. But if you do need to use it, often having 2 years worth of bonus history really shows that to a lender that you have consistently received these bonuses and they truly are a part of your compensation. So that's another area of that we'd look to evidence, but also look to put into our calculations as well, but of course in that particular shaded manner. Again, it's another aspect of conservatism. Number 5, other mortgages and credit cards. So let's say that you're an investor with 2 properties and you own your own home. The bank's going to want you to declare those mortgages and the repayments that you make on them and the outstanding balances on them. And what they will do is assume your repayments against those and bring that into your modelling. They'll also assume that they'll apply a higher interest rate to that as well. And it's not basically what they're doing is adding a buffer to your actual interest rate. So the buffers that we commonly see are 2.5 to 2.75%. So let's say that you're paying a rate of 5% on that other mortgage. The bank assessing you will assume a rate of 7.5%. So again, it's like stress testing you and putting in a buffer in place against can you actually afford this mortgage. And then with other liabilities like a personal loan, they'll do much the same thing. Mortgages are what they have that stress test on in particular. With credit cards, what the banks do is even if you pay off your credit card in full every month, the banks will consider the worst case scenario and say, well, what if this person maxed out their credit cards? What would be the minimum repayment required to keep that credit card company happy? And that's the number that they're going to use on an annual basis. So what we do is we calculate what their repayments are going to be on your credit card. So we take a 3% minimum repayments required, and we model what 3% would look like if your credit cards were maxed out. And that's the number that goes into your assessment. So if you are looking to maximise your borrowing power, a good thing to do is minimise your credit card limits and just say you've got a couple there that are for 15 grand or 10 grand. When you bring those down to 5 grand, for instance, and close one or both of them, you'll find that your borrowing power steps up as a result. So if you want to get an informed opinion on your borrowing power, then we can factor what impact credit cards will have on your borrowing power when we do an assessment for you. Lastly, of course, they're going to model out the repayments on this mortgage that you're proposing to take out. So you're going to use the amount of that mortgage. What amount are you seeking? Is it going to have any rental income, for example? They're going to have a look at the actual interest rate. So again, let's say it's 5%. They're going to put a buffer on top of that as well. Again, the buffer will be 2.5 to 2.75%. And what they're, of course, doing there is simulating that you can handle rate rises into the future, because it's not very good business for them to give you a home loan if you can't make repayments if the Reserve Bank of Australia raise interest rates and the cost of funding goes up. So they will model that, and they'll do that for fixed loans as well as variable loans. It doesn't matter, they'll just apply it. Again, they'll apply it with interest-only loans too, so it's important that I mention that. And lastly, one of the other major areas is, of course, how much you spend on your outgoings. They call this the household expenditure. So they don't want you to provide a lowball figure. They want you to provide what you actually spend on your household income, household outgoings every month. a good way to tell this is, what do you spend on your credit card a month? If it's $4,000, then your household expenses are going to be at least $4,000. Again, the banks will look at how many dependents you have to care for. So if you've got 4 kids, they're going to assume that your household expenditure is higher than a person who has 2 children. So in summary, the banks are going to want to take the most conservative position possible. They're in the business of staying around for forever and ever. They want their bank to be full of good customers that can handle the mortgage amounts. And you as a customer obviously don't want to get yourself into any danger of a place where you can't afford it. So in that sense, us as a broker and the banks are looking out at it through the right eyes by providing those conservative layers of shading your income, including your true household expenditure, and then covering the bases just around your other mortgages, your credit card limits, and this mortgage, and really stress testing you. Could you handle those rates into the future? They call this responsible lending, and it is the way to go. So that's what's in place here in Australia, and it's pretty much a standard across other countries like the UK and New Zealand as well. As I mentioned before, one of the key parts of our service is we do these calculations using any number of different banks' tools. So we have a fine understanding of which bank is going to let you borrow the most or be the best fit for you based on if you've got a certain criteria. Let's say, for instance, you receive a lot of bonus income or you've got business income. We know which banks are going to view those more favourably or potentially have a bit more flexibility for you. So just wanted to put that out there as a key part of something that really helps anyway. Alright guys, hopefully this whole explanation into what a bank looks for when they assess my home loan has been helpful, and if you've got any questions, please let us know.